Good morning, and welcome to World in 15, your trusted source for comprehensive coverage of today's most pressing events, delivered with accuracy, integrity, and insight.
Major U.S. retailers are slashing prices again, coinciding with a slowdown in consumer spending. This could reassure the Federal Reserve about falling inflation and ease concerns about soaring corporate profits, which have surged since the pandemic began. We have Shelby reporting on this.
The Commerce Department's latest report revealed a slower-than-expected growth rate of 1.3% for the U.S. economy in the first quarter, down from the initial estimate of 1.6%. Much of this adjustment stems from a decrease in consumer spending, a critical driver of economic activity. This aligns with the Fed's anticipation and might contribute to curbing inflation. Upcoming inflation data, expected on Friday, is anticipated to show a 2.7% annual rise in the Personal Consumption Expenditures (PCE) price index for April, mirroring March's increase. The Fed closely monitors PCE inflation to gauge progress towards its 2% target. Policymakers have expressed concerns about inflation stagnating after a gradual decline from its peak above 7% in June 2022. The Federal Reserve is likely to maintain its benchmark interest rate in the 5.25%–5.5% range during its June 11 to 12 policy meeting, a level unchanged since last July. While officials anticipate future rate cuts, they remain cautious, waiting for assurance that inflation will resume its descent. Revised GDP data alongside slightly reduced first-quarter inflation estimates may strengthen the case for rate cuts. Recent corporate announcements of price cuts also support this narrative. Economists like Chuan Vian from RSM US argue that softer demand and lower inflation in the first quarter should be viewed positively, signaling potential Fed rate cuts sooner rather than later. While Fed officials acknowledge a strong consumer base with low unemployment and rising wages, they also note stress among lower-income households, evident in rising loan defaults and credit card debt. The recent wave of price cuts may reflect a shift in corporate strategies, indicating a waning of pandemic-induced pricing power and the pursuit of market share. This dynamic aligns with the Fed's expectations, potentially leading to decreased profits for corporations. Despite a slight dip in earnings, corporate profits remain disproportionately high compared to total income, a trend that persisted throughout the pandemic. Supply chain disruptions and pandemic-related stimulus payments boosted consumer spending on scarce goods, driving up prices and profit margins. As restrictions eased, spending shifted towards services like travel and dining, causing inflationary pressures in those sectors as well. Back to you, John.
Thanks for that update.
Nissan Motor 7201 disclosed in its annual general meeting notice that it paid former Chief Operating Officer Ashwani Gupta $3.7 million in compensation following his sudden departure last year. The Japanese automaker stated it had paid 582 million yen, $3.7 million, to an executive officer who resigned during the 2023 business year. Gupta was the sole executive officer to depart during that period, as confirmed by a company spokesperson. We have Anthony reporting on this.
Last May, Nissan, Japan's third-largest automaker by volume, announced that Gupta, who had served as chief operating officer since 2019 and was considered a leading candidate for the next CEO position, would not be reappointed to the board. In a separate development, Nissan CEO Makoto Uchida disclosed during a press conference on Friday that he would return 30% of his pay for 3 months starting from April. This decision came after a warning from Japan's fair trade watchdog regarding the automaker's underpayment of suppliers. In March, the watchdog cited Nissan for violating Japan's subcontractor law by underpaying 36 suppliers by approximately 3 billion yen in total over a 2-year period starting from January 2021. Nissan stated it had fully reimbursed the suppliers for the deducted funds and implemented measures to address the issue. These measures included establishing a unit under the CEO to gather supplier feedback and setting up an external hotline for related concerns. Back to you, Bella.
Thanks for that update.
U.S. stock index futures rebounded on Friday after signs of progress on inflation reignited hopes for potential rate cuts by the Federal Reserve. We have Jensen reporting on this.
The Personal Consumption Expenditures Price Index increased by 0.3% in April, aligning with forecasts from economists surveyed by Reuters. Over the past 12 months through March, PCE inflation rose by 2.7%, meeting expectations. Core PCE, which excludes volatile food and energy prices, rose by 0.2% last month, slightly below the anticipated 0.3% increase. On an annual basis, it stood at 2.8%, in line with forecasts. At 8:33 a.m. ET, Dow E-minis were up 50 points, or 0.13%. S&P 500 E-minis were up 8.75 points, or 0.17%, and Nasdaq 100 E-minis were up 14.25 points, or 0.08%. Back to you, John.
Thanks for that update.
In the week ending May 29, global equity funds experienced outflows for the first time in 5 weeks, impacted by rising U.S. Treasury yields and investor caution ahead of a crucial U.S. inflation report, which could influence future U.S. interest rates. We have Alana reporting on this.
According to Lipper data, global equity funds saw withdrawals of $4.9 billion, marking the first outflow since the week ending April 24. U.S. equity funds faced outflows of $7.6 billion, while Asian equity funds witnessed their second consecutive weekly outflow, totaling $1.5 billion. Conversely, European equity funds attracted $3.7 billion in inflows. This week saw a rise in U.S. Treasury yields following positive U.S. economic data, including an unexpected improvement in consumer confidence in May and increased optimism about the labor market. The MSCI All-Country Stock Index declined nearly 2% for the week, reflecting investor caution ahead of the release of the U.S. Core Personal Consumption Expenditures Price Index report for April on Friday. In terms of sector-specific funds, financials, healthcare, and consumer discretionary funds experienced outflows of $598 million, $570 million, and $452 million, respectively. Conversely, tech and industrial sector funds attracted inflows of $379 million and $289 million, respectively. Global bond funds received $4.3 billion in inflows, a decrease from the $12.4 billion recorded in the previous week. Global government bond funds, high-yield bond funds, and loan participation funds saw inflows of $877 million, $337 million, and $394 million, respectively. However, money market funds experienced outflows of $5.7 billion, a significant decrease from the previous week's inflow of $17.1 billion. In the commodities sector, precious metals funds saw their first outflows in 3 months, totaling $580.4 million, while energy funds also encountered net sales of approximately $80 million. Data on 29,558 emerging market funds revealed a net sale of $538.1 million in equities, marking the largest outflow in over a month. Bond funds also reported their first outflow in 3 weeks, amounting to $952 million. Back to you, Bella.
Thanks for that update.
Dell Technologies shares plunged by about 14% in pre-market trading on Friday as the PC and server manufacturer anticipates significant investments in AI to impact its quarterly profit. We have Jordan reporting on this.
If pre-market losses persist, Dell, DELLN, is set to lose over $17 billion in market value. Despite doubling in value this year, the company is grappling with substantial AI-related expenses, particularly in hardware, as it seeks to bolster its capabilities in processing complex artificial intelligence tasks, a technology that more businesses are rapidly adopting. The costs associated with building out AI servers in high demand are expected to weigh on Dell's annual margin. The company anticipates a decline of approximately 150 basis points in its adjusted gross margin rate for fiscal 2025. Additionally, Dell forecasted adjusted profit per share of $1.65, plus or minus 10 cents, for the second quarter, falling short of LSEG estimates of $1.84 at the time. Dell reported its results on Thursday. While shipments of Dell's AI-optimized servers more than doubled to $1.7 billion in the first quarter, they accounted for less than 7% of the total revenue. Morningstar analysts noted that AI server sales only contribute a small fraction to Dell's top line and are margin dilutive. Revenue from Dell's primary client solutions group, encompassing its personal computer business, remained flat, with the consumer subsegment experiencing a 15% decline. Dell has adopted competitive pricing strategies in the consumer PC segment as the market shows signs of emerging from a prolonged downturn. During a post-earnings call on Thursday, Chief Operating Officer Jeffrey Clark highlighted that the PC business, which had been in a down cycle for 2 years, is stabilizing and showing signs of growth. He also noted that the strong promotions observed during the holiday season continued into the first quarter. Back to you, John.
Thanks for that update.
Snack maker Mondelez has resumed production of Oreo cookies in Ukraine after its plant in Trostianets, a small city in the eastern part of the country, was severely damaged during Russia's invasion roughly 2 years ago. The plant is now fully rebuilt, having opened partially last year to produce chocolates, according to a company statement. We have Ava reporting on this.
Mondelez clarified that the Oreo cookies and other chocolates manufactured at the Ukrainian factory are not being exported to neighboring Russia. Despite boycotts and calls to cease operations from employees, activists, and investors, Mondelez continues to sell its cookies and snacks in Russia, where it operates 3 factories. The company aims to make its business in Russia standalone with a self-sufficient supply chain by the end of 2023 and has appointed new leadership in Europe, including Russia, earlier this year. While the Trostianets plant was undergoing repairs, Mondelez imported Oreos to Ukraine, according to a source familiar with the company's plans. Additionally, products made at the Trostianets plant are exported to Eurasian countries such as Georgia and Kazakhstan, in addition to being sold in the domestic Ukrainian market. Previously, plants in Russia helped supply these countries. Mondelez emphasized its commitment to supporting and rebuilding Ukraine, stating that there were no more exports from Russia into Europe. Oreos, chocolate wafers with a cream vanilla filling, are one of Mondelez's biggest brands, generating approximately $4 billion in sales revenue last year. Mondelez's other top brands include Milka and Cadbury chocolates, as well as local brand cookies and crackers. Last week, a little over 30% of Mondelez's shareholders backed a resolution calling for an independent study of the risks associated with continuing business operations in Russia, according to a company filing. Back to you, Bella.
Thanks for that update.
Japanese authorities have spent a staggering 9.79 trillion yen, $62.23 billion, intervening in the foreign exchange market to support the yen over the past month. This move prevented the currency from testing new lows, yet it's unlikely to reverse longer-term declines. We have Patrick reporting on this.
Data from the Ministry of Finance released on Friday confirmed suspicions that Tokyo intervened in the market in 2 massive rounds of dollar selling shortly after the yen hit a 34-year low of 160.245 per dollar on April 29, and again in the early hours of May 2 in Tokyo. This intervention was larger than expected, highlighting Japan's determination to alleviate the pain of imported inflation, said Dasaku Ueno, chief FX strategist at Mitsubishi UFJ Morgan Stanley Securities. He added that authorities are likely to continue significant intervention efforts. Despite the billions of dollars spent, the impact has not been sustained and attention has turned to whether and when Japan might intervene again as the yen remains near the 160 threshold, considered the authorities' line in the sand for intervention. Finance Minister Shunichi Suzuki issued a fresh intervention warning, emphasizing that officials are closely monitoring currency markets and are prepared to take necessary measures. While authorities have not confirmed market intervention, they have consistently warned they are ready to act against excessive volatility. Friday's data only shows the total amount spent on intervention during the period. A detailed daily breakdown will be available in data for the April-June quarter, likely to be released in early August. The yen's decline is attributed to the resilience of the U.S. economy and delays in Federal Reserve rate cuts, while the Bank of Japan, BOJ, is expected to be cautious in raising interest rates this year. Japan has renewed efforts to counter excessive yen depreciation, receiving support from the Group of Seven, G7, financial leaders who warned against currency volatility. However, U.S. Treasury Secretary Janet Yellen emphasized that intervention should be limited to exceptional cases, reiterating faith in market-set exchange rates. Top currency diplomat Masato Kanda affirmed authorities' readiness to act at any time to counter excessive yen movements. Despite past limited success in curbing yen swings, there's a likelihood of further intervention, even if the yen doesn't breach the 160 to the dollar mark, according to Masafumi Yamamoto, chief FX strategist at Mizuho Securities. He suggested that Japan likely received backing from the G7, including the U.S., for potential intervention. Back to you, John.
Thanks for that update. Thanks for tuning in to World in 15 for your daily dose of news and updates. Don't forget to hit that subscribe button and turn on notifications so you never miss out on breaking stories and insightful analysis.